Most people think of health savings accounts, or HSAs, as just a place to stash cash for medical expenses. After all, that's what they were designed to do. But here's what most investors don't realize. HSAs can be one of the most powerful retirement savings vehicles in existence. But how is that possible? Well, it's because they're the only account in the US tax code that gives you a triple tax advantage: tax-deductible contributions, tax-free growth, and tax-free withdrawals when used for qualified medical expenses. That's something even a Roth IRA can't do. I'm Aaron Baker, co-owner and investment advisor with Wismar Financial, helping you build generational wealth. Today, we're breaking down exactly how a health savings account can double as a hidden retirement savings tool, especially for high earners and families who already max out their 401ks and IRAs. In this video, we'll cover who qualifies for an HSA and how to maintain eligibility, what happens if you lose eligibility for a short period of time, how to invest your HSA for long-term growth, and a powerful strategy that can turn your HSA into a tax-free retirement fund. By the end, you'll understand why the HSA isn't just a health account, it's a Stealth IRA that can help you build tax-free wealth well into retirement. Section 1. Who qualifies, and what if you lose eligibility? To qualify for an HSA, you must be enrolled in a high deductible health plan, or HDHP. The IRS defines an HDHP as a plan with a minimum deductible of $1,650 for individuals or $3,300 for families in 2025, and a max out-of-pocket limit of $8,300 for individuals and $16,600 for families. If your plan meets those requirements, you can open and contribute to an HSA. A lot of times this option is offered through your employer's cafeteria-style benefits package, which also includes your health, dental, and vision. But you can also open your own account through providers like Fidelity or Lively. The annual contributions for 2025 are $4,300 for individuals and $8,550 for families. And if you're over 55, you can contribute an additional $1,000 a year as a catch-up contribution. And remember, these contributions are 100% tax deductible, even if you don't itemize your taxes. Now, here's where people can get a little tripped up. What happens if you lose eligibility for a period of time? Let's say you switch jobs or elect to not have an HDHP for a period of time. In that case, you simply can't make new contributions while you're ineligible, but your existing balance is perfectly fine. The money you've already contributed continues to grow tax-free, and you can still use it for qualified medical expenses at any time. If you regain eligibility later, you can just start contributing again, as if nothing happened. So it's not like losing HSA eligibility resets the clock or disqualifies your prior funds. It just means you take a pause in contributing, but your account keeps growing, untouched by taxes. And that's what makes this tool so attractive for long-term wealth building. Even if your health insurance changes a few times throughout your career, the HSA keeps compounding in the background, quietly accumulating tax-free growth. Section 2. Investment options and choosing the right custodian. Now let's talk about what really unlocks the retirement potential of an HSA: investing the balance. A common mistake is just leaving HSA funds sitting in cash, treating it like a checking account for medical bills. But the real advantage comes when you treat your HSA like an investment account. Many HSA custodians like Charles Schwab, Fidelity, and Lively allow you to invest your HSA funds in mutual funds, ETFs, and even individual stocks once your cash balance reaches a certain threshold, usually around $1,000 to $2,000. Now, here's the ideal way to manage the account. You keep a small cash buffer for minor medical expenses, and then everything above that threshold gets invested in a diversified portfolio, similar to how you'd invest a Roth IRA or a 401k for long-term growth. If you work with an advisor, like at Wismar, you can even open an advisory managed HSA account that allows your advisor to help you allocate the HSA balance strategically, just like your other investment accounts, so that all your investment accounts are working together towards one common goal. And that's where this starts to feel less like a medical account and more like a retirement portfolio with a side benefit: ability to use it tax-free for healthcare costs in the future. Section 3, the Stealth IRA. This is where the real magic happens. When you plan and invest funds in your HSA like you would in a retirement account with long-term growth strategy. And it's pretty simple. Fund it each year to the max if you're able to. Don't touch it, not even for medical expenses, as long as you're able to cover them without taking on debt. And let it grow. If you contribute the family maximum every year from the age 35 to 65, including catch-up contributions starting at 50, and earn a conservative 7% average annual return, your HSA could grow to approximately $892,000 by retirement. And that's a pretty good fund for your medical expenses in retirement. And here's a really cool additional feature. You're not required to reimburse yourself the same year for medical expenses. You can save your medical receipts and reimburse yourself from the account years and even decades later, all tax-free. Having that kind of flexibility is what makes this strategy so powerful. Now, what if you never use the money for medical expenses? Well, at 65, your HSA would start functioning just like a traditional IRA. You can withdraw funds for any purpose, not just medical. The only difference is that non-medical withdrawals will be taxed as income, just like a traditional IRA. But that still means the HSA is a win either way. Use it for healthcare expenses and it's tax-free, or use it for anything else after 65 and it's tax-deferred. It is the ultimate hybrid account. Now let's break down the key tactics that will supercharge this strategy. 1, max it out every year. The contribution limits are relatively low, so every year counts. Even missing 1 year can have a noticeable long-term impact because of less compounding. 2, keep your receipts. If you pay medical expenses out of pocket now, save those receipts on a digital drive. You can reimburse yourself tax-free later, even years after the original expense, as long as it was incurred after you opened your HSA. 3, invest aggressively early on. If you don't plan on touching the funds for decades, treat your HSA like a growth portfolio with expected volatility instead of playing it safe. And 4, coordinate it with your overall retirement plan. For high earners who already max out 401ks, Roth IRAs, and backdoor strategies, the HSA can be the next layer of tax diversification and one of the most efficient. Imagine heading into retirement with 3 buckets: tax-deferred assets from your 401k, tax-free assets from your Roth IRA, and a tax-free medical bucket from your HSA. That combination gives you flexibility to draw from the most tax-efficient source in any given year. And that's true tax planning. Not just saving money, but strategically deciding which dollars you'll live on when in retirement. Section 4, when it makes sense and when it doesn't. Now, the HSA strategy isn't for everyone. It makes the most sense for high earners who can afford to pay current medical expenses out of pocket, healthy families who expect relatively few medical costs each year, or investors who already max out traditional retirement accounts and want another layer of tax advantage growth. If you're someone who has regular medical expenses, you might need the HSA for its primary purpose, paying medical bills, and that's completely fine. You'll still enjoy the upfront tax deduction and tax-free withdrawals for those expenses. The difference is just in the strategy. Some use HSAs for today's medical expenses, and others use them to quietly fund tomorrow's retirement. Section 5, a hidden gem for building generational wealth. So in closing, the health savings account might have been designed for healthcare, but in practice, it's one of the most flexible and powerful wealth building tools available. It's tax deductible on the way in, tax-free while it grows, and tax-free when you take it out for qualified medical expenses. And even if you don't use it for healthcare, it still converts to a traditional IRA after 65. So while most people overlook it as just another account, those who understand the strategy can quietly build a 6-figure tax-free retirement fund in addition to their 401k or IRA. If you want to explore how an HSA might fit into your overall retirement plan, or if you're curious which custodians and investment options align best with your strategy, please reach out to us at Wismar Financial. And if you found this video helpful, we would really appreciate a like and subscribe so we can reach more families with this important information. And please stay connected with us. Our socials are in the description below. Thank you for watching, and we'll see you in the next video.